This tells us exactly how many jobs were created or lost last month and is one of the biggest market moving numbers all month. This data is critical because it will heavily influence the pace of the Fed's expected interest rate cuts. An additional upward move I will be expecting to hit the next objective we have here. Hello, my name is Isaac Martinez, a trader and market analyst here at xChief, and welcome to our weekly outlook. With S&P 500 and the Dow Jones pushing into new all-time highs, the critical question is whether this momentum can continue. This week, all eyes are on the pivotal PCE inflation report, a release that could solidify the Federal Reserve's path toward a September rate cut and dictate the market's next major move. Stay with us as we break down these and the other key data you need to watch. Let's start with the economic calendar, and don't forget the hours you're going to see are based on the New York time zone. At 10 a.m. we have the ISM manufacturing PMI from the United States. Think of this as a major health check for the US factory and manufacturing sector. It tells us if the industry is expanding or contracting, which provides a really good clue about the overall health of the economy and can directly impact the US dollar. After that, the week starts off pretty quietly until we hit Wednesday, 10 a.m. First is the JOLTS job openings, which shows how many jobs are currently unfilled. A high number here suggests companies are confident and looking to hire. On Thursday, the action starts at 8:15 a.m. with the ADP Non-Farm Employment Change. This is a report from a private company that estimates job creation, and traders watch it very closely because they see it as a preview or a warm-up for the official government jobs report that comes out on Friday. Just 15 minutes later, at 8:30 a.m., we get the weekly unemployment claims. This number tells us how many people file for unemployment benefits for the first time, giving us a very up-to-date look at the job market's health. The week then culminates on Friday at 8:30 a.m. with the main event, the official US jobs report, which comes in three parts all at once. First, we have the average hourly earnings, which shows if people's wages are going up or down. Rising wages can signal future inflation, which is a huge factor for the central bank and the dollar. Then we have the main number everyone will be watching, the non-farm employment change. This tells us exactly how many jobs were created or lost last month and is one of the biggest market moving numbers all month. And finally, at that same time, we get the unemployment rate, which is the overall percentage of the workforce that is out of a job. This combination of data on Friday is guaranteed to bring a lot of volatility to the markets as we close out the week. The calendar gives us the timeline, but the narrative is driven by the fundamentals. Let's pivot from the what and when to the why behind the potential market moves. The markets are on high alert for a crucial update on consumer inflation, coming at a time when the S&P 500 and the Dow have just reached new all-time highs. The key report to watch is the Personal Consumption Expenditures Index, or PCE, which is the Federal Reserve's preferred gauge for inflation, scheduled for release at 8:30 a.m. Eastern Time. This data is critical because it will heavily influence the pace of the Fed's expected interest rate cuts. Currently, traders are pricing in an 85% chance of a rate cut at the September meeting, a sentiment that was strengthened after comments from Fed Chair Powell and the Governor Waller, who stated he fully expects more easing in the coming months due to some cracks appearing in the labor market. Economists expect the annual core PCE, which strips out food and energy, to come in at 2.9%. Despite some political noise surrounding the Fed, Wall Street is on track for solid weekly and monthly gains, with the S&P 500 gaining about 2.6% in August after crossing fire the 6,500 level for the first time. Finally, it's important to remember that US markets will be closed on Monday for the Labor Day holiday. Now let's continue with the technical analysis of the assets that we assess week by week. We start as always with the DXY, which is the strength of the dollar. The first thing we need to understand is that throughout the week we reached 2 points. The first one was stated here at the top of this fair value gap, which was developed by the price on Friday, 22nd of August. So after we reached this resistance, it was expected to have a pullback, and now we are having a higher low from the last low that was developed here at 97.556. Unfortunately, we don't have a clear direction for the DXY, and this is because before we can have a bias for the DXY, we need to break out one of these 2 2 points, this resistance located here or this support located in the down part. If the price manages to break the upper part, I'm expecting to have an upward move to 99.569 and 100.256. On the other hand, if we have a breakout of the lower part of the support, I will be expecting to reach the 97.109 and 96.377. Let's continue with the S&P 500, and as we talked before, we reached an all-time high with this asset. It is highly probable after this to expect a pullback to any of the supports that we have been talking last week. The first one can be located here at 6,343, 6,261, and the last one 6,212. On the other hand, if you are expecting for an additional upward move, I will be expecting to hit the next objective we have here at the 1.5 zone from the Fibonacci extension we established last week, which is located here at $6,800. It's a solid target for the people who is bullish with the S&P 500. Next, we're going to see the euro, and we have basically the same structure we are seeing with the DXY, and this is because the strong inverse correlation they have between them. The first thing we need to understand is that we have an upper part, a down part. Upper part resistance here at 1.17304 and the support here at 1.15830. If we're expecting to set a bias, then first we need to wait for one of these parts to be broken. So if we have a breakout of this resistance, we can expect the 1.17889 as the first target, and the second target can be here at 1.18299. On the other hand, if we break out the support, we can expect 1.15276 and 1.13917. If I am trading on the 4-hour chart, I can't take a bias right now because, as I talked before with the DXY, we need to wait first for a breakout to have a better picture of what we have with the euro dollar and also with the DXY. Finally, we have Bitcoin on the broader picture. As you can see, we have a strong bearish movements with lower lows, and that means that if we don't have a strong bullish move that can be related to any kind of fundamental that can strengthen Bitcoin, then we will continue with this downward movement, with this downward trend, so we can expect lower prices. The first one is located in the last low, 108,670. The next one is a liquidity zone at $107,800. And finally, we can expect also here another liquidity zone, $105,100. The worst scenario with Bitcoin that we can expect is to break this support at 98,225, because after this we can confirm a market structure shift, and this means that we can expect now for a downward trend with Bitcoin. And that concludes our analysis for the week ahead. To apply these market insights, I invite you to register for an account with xChief, where you will find professional tools and excellent trading conditions to navigate the financial markets. If you found this video valuable, please support our channel with giving it a like and subscribing for more weekly market analysis. Thank you for your time, and I wish you a successful trading week.